Hey everyone, today on the final bar, I'm joined by Ari Wald from Oppenheimer. Good to have Ari back on the show, talking about some big picture themes going into year end. The S&P really pushing further and further on to the upside. All of that changed in the last half hour, though, with news from Pfizer affecting vaccines for next year, given some distribution. Still overall hanging in there just fine. The S&P down about 0.2%. And overall, this leaves us with the question, where are we at with strong price, strong breadth, questionable sentiment with euphoric readings across the board? We'll get to all of that and more. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, sentiment, breadth, volume, psychology, whatever we can do to try to make sense of this volatile period. And today, certainly plenty of movement going into the end of the day. As always, I've told my daughter, if you really want some excitement, try to host a closing bell show this year, because the things tend to pivot just right at the end of the day. And obviously, the last 30 minutes tends to be pretty high volume and heavy buying and selling that tends to come in. But news from Pfizer this afternoon pushing stocks from a net positive to a net negative, although really overall it's kind of still holding in there pretty well. The long-term trends are what we're trying to focus on and put the short-term movements into proper context. And when you look at some of the charts that we'll be talking about, we're going to do a deep dive in the financial sector. I'm excited to talk with Ari Wald. I know he's going to share some thoughts in some of those names as well. And what you can see is overall trends remain pretty constructive, remain pretty robust. And we're going to try to focus on what's working and what isn't, given the overall strength in the market to date. Now, we have some wonderful guests. I mentioned Ari Wald coming up shortly today. Coming up next week, we have options expert Dan Passarelli joining us for the first time on Tuesday the 8th. On the 9th, we have Chris Vermeulen joining the show for the first time. And then next Thursday, Mark Young from Wall Street Sentiment. Also, as a reminder, coming up at the end of December, sort of going over the holiday last couple weeks of the year, we're doing a series of special programming called Reflections 2020. We're putting a lot of work in to line up some fantastic guests to share their insights about how they think about year end. It's three main areas of focus. One is going to be 10 experts, each sharing their top chart of the year. So we'll have 2 weeks with every day a new analyst sharing their favorite chart to focus on, telling the story of 2020 through their eyes. We'll also do a series of interviews and presentations on wrapping up the year from a performance standpoint. How do you evaluate your performance and rethink about how you should be positioned going into the next year? And then finally, a series on sector rotation. We're going to have Julius de Kempener talk about sectors and how they've been moving, plenty of movements going on in 2020, and then have a series of analysts focusing on a sector or two apiece to do a deep dive and focus on key themes to be aware of. So a lot of really good programming. We're excited to be getting it ready for you here in the next couple weeks, and look for that called Reflections 2020 coming later in the month. As a continuation of the program, let's go to the market recap. As I mentioned, the S&P, really selling off in the last 20, 30 minutes, really finishing about flat for the day. I mean, it sort of bounced around a good amount in the end. I don't think everyone had enough time to really process what's going on here. I think tomorrow is where we'll probably maybe, get a better sense of if that's a broader issue with vaccines or if this is limited Pfizer news. Pfizer down a couple percent on as a reaction today. The S&P essentially flat, 3666 or so. Mid caps and small caps both doing a little better. So small caps leading the way higher, and that's a theme we've talked about for a while. This rotation back into sort of that small cap value trade. And if you look at what worked today, it's energy and real estate up 1% and 0.75% respectively. The Nasdaq essentially flat, and mega caps down just a touch, with the VIX above 21. Looking at other asset classes very quickly, bonds appreciated through the course of the day, with the TLT finishing up 0.1% and 10-year yields around 92 basis points. Looking at commodities continuing to do pretty well, with oil finishing higher. Gold and silver, the metals, really really the interesting place. Let's start with there, because we've talked about this weakness in gold and this rotation away from metals into other places. Looking at the GLD chart, it's been a nice bounce though in the last week, really the last couple trading days. We've had a nice bounce, really off of this support level. This is sort of the 50% retracement of the March to August uptrend in the GLD. Sort of a nice bounce back above the 200-day, and it's interesting when you break down through the 200-day or through a significant level. We always talk about the follow through and validating that breakdown with further movements. And you can see about a day later we start bouncing higher, 2 closes below the 200-day, and we're back above it. So again, until we get a valid breakdown through that level, that you treat that as overall support, similar to what you saw in March. You saw the sell-off to the 200-day, you chopped around there for about a week, and then that continued the next leg higher. The long-term trends on things like gold, silver, overall pretty positive, and it's been a decent pullback here for the last couple months. So it's sort of like if gold is going to work, we've pulled back to the point where we start thinking about, when's the next leg higher going to start to materialize. Looking at a chart of the S&P 500, was finishing stronger during the day, essentially flat. So we have the infamous doji candle on the index. I'm never that specific with it. I'd much rather look at the SPY, which has a sort of a good open and a good close. Same thing there. So, a doji candle, what that means, I'll zoom in here to the last little bit so we can look at it. 3 months. So a doji candle, again, don't worry too much about the name of it, but the idea of it was where you open and close at almost the same level. So what that means, it's from Japanese candlesticks, where essentially, you have a rally into this candle, the open and close is sort of identical, which, anecdotally means that we didn't really go anywhere. We didn't have any further appreciation. We sort of settled back in, and that indecision that's implied by the open and close being at similar levels is a short-term reversal signal. It's only designed to tell you about the next couple bars at most, but suggesting a little bit of weakness here into tomorrow, all else being equal. The longer-term trend, though, again, by any stretch of the imagination, has been positive, and plenty of stocks looking strong, stocks breaking above resistance and holding them. The S&P, that level from 3550 to 3600, that's the range that we've been talking about for the last couple months, really since the September high when we approached 3600 and failed. Sort of the upper bound, we've now broken up, have tested that, traded around that level, and now I would argue have followed through to the upside. So until proven otherwise, the trend is positive. Not overbought yet, so the S&P overall is in a sort of a decent uptrend, a nice trajectory, and the long-term trend remains positive. And I don't see anything yet telling me to rethink that overall thesis, especially when you look at breadth, which has remained fairly positive. Looking at sectors here very quickly, you had energy and real estate up, as I mentioned. After that, it was everything sort of a little different. Those are sort of the haves, and then it's the rest of them. Consumer discretionary, industrials, consumer staples, all up about 1/3%. On the downside, you have utilities. Utilities are an interesting one. This is a sector that had been doing well. The relative movement, or the relative strength, has started to improve, and you felt this movement toward the higher yielding names in a sector like utilities. But while other sort of dividend-oriented, value-oriented sectors have done pretty well, utilities has actually been a fairly consistent underperforming. That relative strength line has turned back down. Materials as well on the, next to the bottom. I looked for stocks making new 13-week price lows today in the S&P 500. It was only 2 stocks. One was Regeneron, which we'll talk about in a little bit in the biotech space. Obviously, the other one was, what was it, AMT, I want to say? One of the materials names, to be honest with you. Going a little further down in terms of what was moving, you'll see some industrials groups in the top 10. Looking at the Dow industry groups, airlines certainly impressing to the upside with the airlines group up 4%. A lot of times we'll look at the XAL, the $XAL chart. Let's look at that very quickly here. The other one is JETS, the JETS ETF. And so if you look at the airlines index, again, you can see the June high. It looks a lot like some of the financials charts, to be honest with you. Had a peak in June, never really reclaimed it. We've now traded up to it, if not gapped up to it, now traded through it. And you've had these, these pullbacks that have just given you these clear sort of trailing stops on the way up. I think with a lot of these charts, you can draw trend lines from the lows and sort of draw this nice clean uptrend tracking this move. With something like airlines, they're overbought. That doesn't bother me yet. Overbought means up a lot is the phrase we usually pass around. That's not a bad thing. That means that the price has gone up. That's what we kind of want if you're looking for higher prices. The problem is when that no longer is the case. So when it comes out of the overbought region, that's when you want to look back and see if it's able to hold some of these recent support levels. But overall, I'm impressed by what I've seen from the XAL and also some of the individual charts like American Airlines and others that are actually doing pretty well, better than you might expect. Home construction also in the top. These are coming out of pretty low levels, and if you think of some of the home builder names, the charts have not been great, especially on a relative basis. These are things that are testing more the lower end of the range as opposed to breaking out. So looking at things like the ITB or the XHB, again, they're coming out of sort of the lower end of this range. But again, if you're looking for entry points, something like this is the XHB here, pulling back to an ascending 50-day moving average might not be a bad time to add into some of these. If you're anticipating further upside, it's sort of that traditional buy on the dips type of chart. So, groups like that have not been doing well are sort of testing the lower end of the range. When something like 52 would not hold, that's on the ITV, that's when I would start to get concerned. And the problem with something like Regeneron is it sort of looks like the ITB, but it didn't hold, right? It sort of had that level. It's now broken down through moving averages, now making lower highs, lower lows. Those are the charts I think you want to avoid overall. That's our market recap, touching on some of the key themes of the day, a lot of movements, which we'll pick apart later in the show. Let's take a quick break. Back with Ari Wald from Oppenheimer. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for the Final Bar. As a reminder, we're going to do another mailbag segment in tomorrow's show on Friday. You can get your questions to us three ways. Number one, via email. Just email us at thefinalbar@StockCharts.com. Number two is on Twitter at FinalBarSCTV. Just tag us in any comment. Finally, on our YouTube channel, just put a comment below the video. We'll capture all of those and hopefully answer one of your questions in tomorrow's show. I want to welcome on my guest back to the show, Ari Wald from Oppenheimer. Ari, I welcome back, and I have to thank you first off. I try to pound the table with our viewers about, getting away from the short-term noise, focusing on the long-term. You brilliantly brought two long-term charts, so welcome back and thank you.
Yeah, always a pleasure, Dave. Thanks for having me back on the show.
So first, I highlighted in the market recap, today you have small caps outperforming. That's been a theme that we've seen with this sort of rotation, away from the mega cap trade into things like small cap into value. Start us there, and what are you seeing about that relationship?
Yeah, so, the case for additional market gains has, I think, become somewhat consensus, but it's a consensus call that looks highly likely to continue, given the undeniably broad-based breakaway we're all witnessing. So instead, the top question from our clients is whether we should expect a change in leadership as the economy digs itself out of recession. And we think the answer is yes, speaking in terms of small caps versus large. So the bottom panel in our first chart here shows how the Russell 2000 has performed versus the S&P in relation to past US recessions. And so the recent turn identifies that small caps are taking on a leadership role following 6 years of underperformance dating back to 2013. So as far as rhyming with history, we think this looks similar to the underperformance suffered through the mid to late 1980s and the small cap reversal coming out of the 1990 recession. So both instances also occurring with a big breakout in price, as we show in the top panel. So again, the point is that as consensus as the early cycle recovery has become, there's a reason for it. The market behavior is supporting that type of action.
You know, it's so funny. And I remember not too long ago, the question was, could the market, continue to rally without the FANG stocks leading? And it's kind of what we're seeing right now is that, market moving higher and the FANG stocks, things like Amazon and others sort of at the lower end of the range, not really participating at all. And it seems to me that if you think of the late, early 90s as an analog, that's certainly possible.
Yeah, if it was concerning when they were the only things, not working, should be bullish, right? The converse of that. Now that these other areas are taking on a leadership role, I would argue that it's not that they're breaking down, they're pausing. And actually, I think some of those large cap growth names look ready to lead the next leg of the advance.
It's very interesting. Now, chart number 2 is taking us into the financial sector, looking at capital markets. What are you seeing here?
So I wanted to finish off with an industry idea to make the case that we think indeed capital markets are an attractive way to gain exposure to what we would call new leadership. So the first thing to note is the industry is breaking through resistance dating back to its peak right ahead of the great financial crisis in 2007. What a long, straight trip it's been here. Second thing to note, it's how it's doing relative to the market in the bottom panel. Now consider that interest rates fell to a new all-time low this year, and the banks industry also fell to a new cycle low versus the market. However, the more diversified capital markets held both its 2012 and 2016 lows. So we think this has created a stronger base that should support more durable outperformance than, say, the banks, which have been trading more in lockstep with rates.
That's a great chart. It's so funny. I actually, one of the charts I posted on Twitter earlier today was looking at, I think it was the broker dealers index, like XBD, and I was comparing that to semiconductors. And if you look at one of them quickly, it's hard to differentiate the two of them. Are actually in a very similar pattern with a nice breakout, which you would not have guessed not too long ago at how well some of these financial stocks have actually started to really participate, right?
Yeah, it's been part of this beta trade. Within technology, it's gone to the beta part of it, which is semis, and now you have financials getting involved there as well. So again, it kind of emphasizes that point. It's not tech or financials or another part of the market. It's an and in there. It's tech now and financials in these other areas. It's just how broad it's been, which I see as bullish, compelling bullish evidence.
No, we only have about 30 seconds left, Ari, but I'd love to ask you, right? So price certainly impressive with the S&P going to new highs. The rotation is showing you the breadth of the market with, leadership coming from places like financials we hadn't seen before. That the third piece I would consider would be sentiment, which is sort of on the euphoric side. You have, flows being, super bullish. You have sentiment readings overly bullish. Does that concern you at all? Or how do you, reconcile that with a trend that just remains fairly positive?
And that would be the one potential concern looking out in the horizon. Look at some of the polls that we track, whether it's Investors Intelligence. Optimism is certainly on the rise. I would argue it's not at extremes just yet, and I think sentiment does provide its best signals at an extreme, still well below the readings from January of 2018, which was an extreme in sentiment.
Sure.
So from that perspective, something to watch. But I think for now, bull market continues.
When in doubt, follow the trend. Ari Wald, it's such a pleasure to have you on. I appreciate it. Followed your work for years. I respect what you do and respect you a great deal, and appreciate you having you on the show today.
Love being on, Dave. Talk to you next time. Happy holidays.
All righty. Sounds good. It's Ari Wald from Oppenheimer with some great thoughts. Again, what I love about Ari's work, it's sort of take a step back sort of perspective, which is so important. When we were chatting just before the show, the Pfizer news is coming out, stocks are rotating over very quickly. And we made the comment of it's so easy to get caught up in that short-term news and try to project what you're seeing in the short term and turn that into a long-term thesis, into a long-term idea. And what we've certainly advocated, and I think what you hopefully saw with Ari's work is the charts are long-term, and it's all about how today's movement is just one day among many, and looking at the trend over the course of those many days is what I think allows you to capture the long-term momentum over time. So a great take there. Our next segment is called the Sector Deep Dive. This is where we occasionally focus on one particular sector, try to dig out the key themes and patterns to pay attention to. We're going to look at the financial sector. When I saw where Ari was going to go. It sounded like a great opportunity to dig a little bit into the financial sector. And again, what we're going to do is use stock charts to sort of tell this story. We're going to use a couple different reports that you have access to on stock charts. If you go to charts and tools, we're going to hit some of these reports that are on the right side. You can also access these, by the way, from your dashboard. But we're going to focus on the sector summary and the industry summary reports, and then look at some of the charts as a result. So if you look at the sector summary, it's just going to show you the 11 S&P sectors. What I always do is sort it by the scooter rankings. So this is looking at essentially these ETFs relative to our entire ETF universe, and it's showing you the percentile ranking. So technology, number one, communication services, number two, and so on down to utilities and real estate, which have been the lowest ranked in the scooter rankings. And as you can see, something like energy, which has jumped up pretty well, is still 15th percentile among all the ETFs out there. So what you have to remember is it's a relative move, and it's also geared more toward the long-term trends. It's about 60% long-term, maybe 30% medium-term, maybe 10% short-term, and I'm totally making up those percentages, but I think it's pretty close to that. If you look at our Chart School article on the scooter methodology, you can see exactly what makes up that stock charts technical ranking. But it is a way to look at a group of anything and sort them from strongest to weakness in terms of overall their, their intermediate trend is how I would describe it. So tech, communication services, number one, and number two. Financials are here middle of the road, about 59th percentile, but as you'll see, some of those charts are actually starting to really improve coming out of a relatively weak level. And the question is this earlier on in that trend where financials really start to perform well? If you go to the industry summary page, which is another report that you saw there, I'm using the table view here, so you might have to switch to that if your screen looks a little different than mine. But we're now sorting each of these sectors, looking at their industry groups. And again, I'm sorting them by their scooter rankings. So if you look at the financial sector in particular, this is the strongest to weakest industry. So we have a separate scooter ranking for all the Dow industry groups, about 106 of them from 1 to 106, and it's by percentile ranking. So the higher the number, the stronger the trend. The top three groups within the financial sector are financial administration, investment services, asset managers. Now, the chart that you saw from Ari Wald, which was talking about capital markets, there's no actual capital markets group with the industry methodology we're using, but you'll find them in groups like investment services. You'll find some of those names, and maybe pepper around some of the other ones. I haven't really looked at exactly the mapping, but that's kind of those types of names. What I wanted to do is just go through these three top ranked groups and look at some of the strongest stocks in there. Now, this is just the beginning. We have time to do a limited deep dive with a 30-minute show. I hope this encourages you to do a little deeper work of your own. Follow this methodology, but keep going. Look at what the strongest, the weakest sectors, the strongest, the weakest groups, the strongest and weakest stocks within those groups. That's what will help you identify which stocks are in the move and which ones are struggling. If you look at the top ranked stock in that top group, which is financial administration, it's ADS. Alliance Data System. So again, let's look at the chart here. And what you'll find here, again, if you didn't know this is a financial stock, it might actually, you might think it's something different because it's had this nice run actually off of the March lows. Now the relative strength has tapered off. So you see, like a lot of financial stocks, top down in June and then spend a long time trying to get back up to that level. And that's what, I think a lot of the financial names look kind of unique in that way. A lot of other things sort of performed well during that period, which is why the relative strength line here sort of struggled because it was, again, underperforming the average stock over that period. But that's changed. And if you look at the relative profile in November, it's one of the better places to be in terms of an acceleration to the upside. This is a stock that broke above its 200-day and has not looked back, now pounding out a nice pattern of higher highs, higher lows as it continues on. It's overbought right now, which again doesn't concern me a ton. That's what has happened in previous peaks within this overall trend. And again, you might want to look to see if there's a bit of a pullback here, an opportunity to get in on a strong name and a little weaker level. In terms of the longer term, perspective on something like this, what I would always do is look at this sort of thing, right? If you look at the peak that you saw in June, a lot of these stocks broke above and then retested that peak from, broke above it, retested it from above, and then continued higher. On any sort of pullback, remaining above there, I would argue, is pretty key because that means it's staying above that key support level, which was key resistance. That's a great line in the sand to pay attention to. If it would break that on a downturn, that would suggest to me that it might be a change of character. You might want to revisit it a little bit, but as long as it remains above that kind of thing, I would be pretty happy. What's good about these stocks is they've given you some additional sort of pullbacks, thinking more shorter term. There are short-term swing opportunities you might want to identify on the way up there. So within financial administration, ADS is the top ranked name. You see some other, these are more small mid-cap names you may be less familiar with. And it's one of the things I love about these Scooter reports that break down the individual names. There will be small and mid-cap stocks similar in the type of company and the type of business to some of the names you are familiar with. And I would encourage you to dig into some of those and see if there might be some opportunities a little further down the cap tiers. Group number 2 is investment services. This is where you're going to find some of the stocks that were part of the capital markets group that Ari was talking about. Morgan Stanley is the number one ranked stock in that group. And if you look at this chart, it's an impressive one. This is one of the mindful 6. We talked about that at times. That's a six stocks representing some different industries, and Morgan Stanley is the only financial stock that was in there. But it was just a good example of a stock that had hit a peak in September, pulled back to the 200-day, and it's sort of in this range now between the September peak and that low at the 200-day. Is it able to break out to the upside, or does it fail at support? And clearly the answer was positive. The gap higher there in early November, and then it's just continued. And what strikes me on a lot of these charts when you look at the top ranked names is this: if you take that low toward the end of October, connect it to the high that we saw in sort of mid to late November, wherever we saw a pullback, it's tracking really well to this uptrend. Now, I would have to say a breakdown of that trend line would not tell me the trend is over. It just tells me that it's a change of some sort, right? It would be a time to reevaluate. That would be the time to look at some of those previous support levels and see if it's able to hold some of those levels on a pullback of sorts. But Morgan Stanley, definitely the strongest name in that particular group, which is called investment services. Finally, the third group is asset managers. This is where Invesco comes in. Invesco has been one of the strongest names across the entire large cap universe, ticker's IVZ. And if you look at this chart, again, it's a pretty impressive run. It's similar to the Morgan Stanley chart, but even a better acceleration to the upside, really far above its 50-day moving average, which the challenge with that is if it pulls back, you have a long way to go down there for support. So if you're getting into a name like this today, or if you're looking for it, it can be a little disconcerting to see the 50 days so far away. That's why I would say that trend lines like this can be really helpful. A clear support level in September, clear support there in late October. We remain above that trend line. There's no reason to be too worried about that trend. Overall, it's accelerating just fine. That second chart on the way, the second one on the one, Waddell and Reed buyout news today, which is making a gap up about 50%. I think it was Macquarie Bank that was it's going to be taking them over. So again, some of these names you may be familiar with, some of them you may not, and this is a really good way to sort of throw them in a pile, see what bubbles to the top. That's our deep dive on financials, and boy, we're already at the done with the show. 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the AAII Sentiment Index. I asked Ari at the end of our interview there about sentiment because, again, I totally agree with him. Price is strong. Breadth is encouraging. The leadership rotation is powerful. All of that speaks to higher highs. What concerns me is we are getting near, we're in that euphoric level. I would say I'm probably a little more contrarian on this one than Ari might be. He's saying, we're not to the extent that we were at the January 18 peak, which is absolutely right. But we're certainly accelerating. And so that is one thing that tells me to maybe mentally tap the brakes a little bit. But again, as long as price and trend remain positive, you have to follow that. Chart number 2 is airlines. Again, I couldn't believe I tweeted earlier how good the airline charts look, but they do. They're actually coming out really nicely, broken above the 200-day, back above the 50-day. This is $XAL. The Jets ETF is another one that people will follow, or just some of the main names, AAL, DAL, and others. And you can see this resistance in June. It's similar to the financial stocks we talked about, tested that resistance again, and now just breaking to the upside. The relative strength is what's most impressive for me on airlines. Now, as a reminder, the benefit of trend following is you will see when stocks are working, you will see when stocks are not. Even though biotechs are holding up pretty well, there are stocks within that group, in particular Regeneron, one of the ugliest charts on a relative basis I've seen, just because of this clear rotation from accumulation to distribution. It's broken down through all the moving averages. The relative strength has gone down. I would much rather own stocks that are outperforming than underperforming in any environment. Folks, that's our show for today. Special thank you to Ari Wald from Oppenheimer for joining us from the New York area. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.